Good morning, everyone. Today, we will present the 6 themes that you see on the screen. I am Akihiro Matsuo, President and Representative Director of TECHNOS. I will cover the overview of financial results for the first half of the fiscal year ending in March 2026 and the explanation leading up to the consolidation of MTech and HTK Europe into the group. Hiroyuki Tanaka, our Chairman and Representative Director, will explain the latter 2 themes. First, I will explain the financial results summary for the first half of the fiscal year ending March 2026. Net sales were 69,384 million yen, achieving 96.8% progress rate versus H1 forecast. Operating profit was 1,464 million yen, achieving 135.6% of the target, driven by an improvement in gross profit. However, compared to the same period last year, operating profit decreased by 11.2%. As explained later, this decline was due to due diligence and M&A-related expenses for MTech and HTK Europe as well as increased SG&A expenses. Ordinary profit was 1,768 million yen, achieving 145% of the target, while profit attributable to owner of parent was 1,207 million yen, achieving 142.9% OR. This graph shows quarterly performance. Net sales were slightly below the same period last year but exceeded the most recent quarter. As for our business environment, while demand recovery has been slightly slower than anticipated, we are seeing a recovery in orders received, which now exceed the same period last year for 4 consecutive quarters. Orders received and orders backlog are leading indicators that will translate into future net sales. Therefore, we anticipate a steady recovery in net sales going forward. The orders backlog remains stable. Starting around 2021, component shortages had led to extended product lead times, resulting in a significant number of advance orders from customers. As a consequence, new orders were weak in 2023 and 2024. However, recovery is now visible in the most recent period. Moving on to the regional breakdown, demand recovery continues in Japan, with all 3 indicators, net sales, orders received, and orders backlog, exceeding the same period last year. However, in Asia, primarily China, demand recovery is lagging, resulting in sluggish growth. Here are the details of performance by regional segment. In Japan, sales of electric machinery and transport equipment for semiconductor production increased. Additionally, sales of electronics components for automotive-related industry grew. The sales to the amusement and the new energy-related industries also rose. In Asia, sales of electric machinery for China's solar-related industry decreased. However, sales of electronics equipment for industrial robots increased. In Europe and North America, sales of electronics equipment for FA industry decreased. Next, we will move on to the performance by business segment. In the electric machinery business, the sales of electrical equipment for the semiconductor manufacturing related increased, while sales to the solar power industry decreased. In the electronics equipment business segment, the sales grew in sectors such as the automotive and amusement-related industries. In the general machinery business segment, the sales for the semiconductor manufacturers declined. Next, I will explain the factors affecting the change in operating profit. Although net sales increased and gross profit margin improved, overall operating profit declined year-on-year due to the negative impact of exchange rate fluctuations and SG&A expenses caused by the recognition of M&A-related costs. However, thanks to our continuous SG&A reduction efforts, we significantly exceeded the H1 forecast announced at the beginning of the period. As detailed in later slides, in the new medium-term management plan launched this fiscal year, we prioritize strengthening profitability. We aim to achieve higher profitability by synergizing our customer segment, product, and area strategies. Through these initiatives, we will enhance our earning power and strive to increase operating profit. Finally, as the last part of the first half financial results, I will explain the balance sheet overview. Due to our business model, current assets constitute a large portion of total assets. Therefore, from an asset efficiency perspective, we place significant emphasis on the cash conversion cycle as well. In practice, inventory turnover days, a component of the cash conversion cycle, continue to decrease, contributing to the overall shortening of the cash conversion cycle. Our business fundamentally centers on delivering manufactured and finished products to our customers. We therefore monitor inventory efficiency at fixed points and strive daily to improve them. As a result, our cash conversion cycle decreased by approximately 10 days compared to the fiscal year ended March 2025. Next, we will review the full-year earnings forecast. While the first half results exceeded forecast figures at each profit stage, we remain the full-year outlook unchanged due to delayed recovery in overseas demand, primarily in Asia. Next, I will discuss the progress of the 12th Medium-Term Management Plan announced in this May. The KGIs for the 12th Medium-Term Management Plan are to achieve operating profit of more than 8 billion yen, ROE of more than 10%, and a PBR of more than 1.0 times. To realize these, we established three fundamental policies. First, as a prerequisite for growth, we are implementing business structural reforms to adapt to changes in the market environment. Second, as a foundation for growth, we are advancing our investment, DX, and human resources strategies. Third, as the drivers of growth, we are implementing the three growth strategies, such as product, customer segment, and area strategies. As one of the fundamental principles of our 12th Medium-Term Management Plan, we are advancing strengthening profitability through three growth strategies, centered on a customer-focused area strategy. Specifically, product strategy is proposal capabilities rooted in product expertise. Customer segment strategy is sales capabilities grounded in industry expertise. Area strategy is sales capabilities focused on customer proximity. These strategies are designed to interlock like gears, collectively enhancing overall profitability. To accelerate this synergy, we implemented structural reforms that are business organization restructuring and customer segment expansion. Next, I will explain customer segments. We expanded our previous 6 customer segments by adding medical equipment and social infrastructure, establishing an 8-segment structure. This expansion broadens our strategic reach beyond our traditional strengths in semiconductor production equipment, robots, and machine tools to include areas with high societal demand. Furthermore, under the structure of 5 domestic branches and 3 overseas regional headquarters, we are strengthening new customer acquisition within each area to expand our customer base and advance our strategic initiatives. To accelerate implementation of our product strategy, we reorganized the sales division into 4 divisions: electronic components, control devices, industrial computing, and FA solution. The definitions of each division are shown on the slide, and we classified our major manufacturers we handle according to those definitions. This structure enables each division to enhance product expertise and develop and execute strategies tailored to specific market characteristics, focusing on discovering and creating more specialized products. This reorganization allows each division to maximize its expertise, aiming to improve the depth and speed of our product strategy. Next, I will provide an update on our customer segment strategy and progress for the first half of FY 2025 across the 8 segments. The existing segments include semiconductor production equipment, robots, machine tools, in-vehicle components, FA components, specialized equipment, and new segments include medical equipment and social infrastructure. These segments are broadly on track to meet the full-year FY 2025 targets. I will explain the details of the 8 segments. First, the semiconductor production equipment. The overall market continues to experience elevated growth driven by strong capital investment in advanced logic and next-generation memory, fueled by expanding AI demand. We secured multiple key projects with major customers. Proposals for control panels and wafer transport equipment were adopted, demonstrating steady results. Leveraging our technical proposal strength, we are addressing the industry's investment demand and drive sustainable growth. Secondly, it is about the robots. From a business sentiment standpoint, inventory adjustments run their course, and the market is now in a bright recovery phase supported by demand for automation and labor-saving measures. In particular, AI-enabled and collaborative robots are expanding beyond manufacturing into logistics and service sectors. We are securing new projects in robot-related infrastructure areas such as remote support and cybersecurity. Working with our overseas bases, we are co-developing new products with European and U.S. manufacturers. We expect sustained growth by embracing both market recovery and technological advancement. Finally, we move to the machine tools. After a downturn in FY 2024, the machine tool industry is shifting to a gradual recovery trend. We enhanced our proposals for system solutions for process integration and automation, securing multiple new projects. We deepened relationships with existing customers through combined mechanical and electrical product offerings and won multiple new projects. Against the backdrop of higher performance and digitalization of mother machines, we are steadily improving our profit structure. Next, we'll focus on the medical equipment and social infrastructure segments, which we've newly positioned as key growth drivers. The medical equipment market is expected to grow steadily, driven by Japan's super-aging society and advances in digital technology. Demand is rising for ICT-integrated medical devices such as telemedicine equipment and AI-assisted diagnostic systems. We are strengthening collaborations with specialized manufacturers, focusing on fields like dialysis equipment and surgical assistance robots. We will steadily expand our customer base by discovering high-value-added products, cultivating this area as a new revenue source. Next is social infrastructure. Domestic capital investment in public and industrial infrastructure remains robust, driven by decarbonization, infrastructure renewal, and DX. We strengthen proposals for power and gas sectors, securing projects for substation digitalization and prototype development for railway infrastructure. Additionally, orders for EV chargers through automotive manufacturer channels are progressing, indicating expansion potential for future energy infrastructure business. We continue to establish a stable revenue base by providing optimal solutions in sectors supporting society's foundations. Next, I would like to talk about in-vehicle components. The in-vehicle components are accelerating structural changes of the entire mobility driven by electrification, autonomous driving, and connectivity. We are strengthening entry into advanced driver assistance systems, human-machine interfaces, and infrastructure integration fields. In addition, we are advancing product proposals addressing electrification themes to support next-generation vehicle development, increasing touchpoints with existing and new customers and enhancing customer satisfaction. In environmental and safety domains supporting mobility evolution, we are strengthening proposals in fundamental areas such as control, sensing, and electrification technologies. Next is the FA components, an area where we excel. Across the manufacturing industry, the need for labor-saving and automation is growing significantly. This is a very important growth domain for us. We advance technical proposals by combining optimal electronic components after thoroughly understanding circuit configurations and control systems of customer equipment. We contribute to overall equipment reliability and efficiency by providing solutions based on electrical characteristics and design intent, not just supplying parts. Furthermore, we provide packaged solutions, such as configurations combining control modules and sensors for conveyance equipment and robots, and we provide proposals that include communication and power systems for energy management and AI inspection systems. These activities allow us to deliver technology-driven, high-value-added solutions to a broad customer base, reinforcing our position as a technology-driven trading company with strong proposal capabilities. Finally, we reach to the specialized equipment. As automation and efficiency needs continue to across industries, we are advancing proposals to optimize equipment configurations tailored to customer applications. Specifically, by gaining a deep understanding of each customer's application, we propose products that modularize system configurations by function, helping customers achieve greater efficiency and reliability in equipment implementation. This approach enables us to go beyond simple supply, delivering high-value solutions that directly address customer challenges. Furthermore, by introducing globally competitive products and offering high-value unit proposals that swiftly respond to industry trends, we aim to strengthen our presence both in Japan and overseas and secure a leading position in the market. Please take a look at this slide. It illustrates the integrated framework for implementing our 3 growth strategies. First, product strategy. We clearly define key manufacturers for each division and actively pursue development of cutting-edge products. In addition, we are developing solutions directly addressing customer challenges such as robot, transport, and machine control solutions. These activities enhance our unique value as a technology-driven trading company. The customer segment strategy categorizes key customers into their respective industries, enables strategic approaches tailored to sector characteristics, and fosters deep relationships with manufacturers and customers. The area strategy connects these two. Leveraging our network of 30 domestic and 40 overseas locations, we link product and customer information at the field level. By sharing insights cultivated in each region, we expand locally generated business opportunities globally. By integrating products, customers, and regions, we sharpen our core strength as a customer-centric, independent, technology-driven trading company. This positions us to surpass the KGIs of our midterm management plan. Operating profit of more than 8 billion yen, ROE of more than 10%, and PBR of more than 1.0 times. Looking ahead, we continue to remain agile flexibly to changing market conditions while driving sustainable growth in corporate value. Next, let me explain M&A within our investment strategy. In our midterm management plan, SGP 2027, we position investments that support growth as business-coordinated strategic investments, not merely to increase scale, but to generate synergies and coordination with our existing businesses. Based on this approach, we executed 2 M&A deals in FY 2025. The first was the acquisition of MTech as a subsidiary in Japan to strengthen our domestic engineering capabilities. The second was the acquisition of HTK Europe as a subsidiary to expand our business foundation in Europe. The objectives and future developments for each will be outlined on the next slides. First, I will explain about MTech, which we made a subsidiary at the end of September 2025. Based in Kyushu, MTech brings high technical capabilities and flexible responsiveness in solutions for industrial machinery and equipment, including the design and manufacture of FA control units and the construction of inspection and transport systems. MTech has advanced technical capabilities in the robotics and FA fields, and our group has collaborated with them through business partnerships for some time. By completing this subsidiary acquisition through an equity transfer and integrating their technology into our group, we are strengthening our FA solution and motion control proposal capabilities and technological innovation power for our customers. The purpose of making MTech a subsidiary is to internalize innovation by acquiring manufacturing capabilities. This enables us to strengthen our product lineup in robotics and FA. MTech's strengths lie in proprietary motion control technology utilizing sensor information and 3D analysis technology using 3D CAD. Its unique control technology realizes flexible automation systems capable of handling complex movements. Furthermore, its 3D analysis technology enables rapid design of optimal production processes and equipment specifications. By enhancing pre-implementation verification accuracy, it reduces implementation costs and contributes to shorter delivery times. These technologies also align with digital twin and physical AI technologies that will shape the future. The addition of MTech's proprietary control and analysis technologies to our solutions will differentiate our offerings and expand opportunities to secure complex, high-difficulty FA projects. Thus, the acquisition of MTech as a subsidiary represents a crucial step toward building a new growth model that integrates technological capabilities with trading company functions. Moving forward, we continue pursuing sustainable corporate value enhancement in line with the strategic investment policy of our medium-term management plan. Next, I would like to talk about the acquisition of all shares in HTK Europe Limited, effective October 31, 2025. We acquired the shares from Honda Tsushin Kogyo Company, Limited, a wholly owned subsidiary of Minabiya Mitsumi Incorporated. The company changed its name to TECHNOS, UK, Connect Solutions Limited. The purpose of making HTK Europe a subsidiary is to acquire local manufacturing capabilities to accelerate our entry into the European market. By incorporating HTK Europe's manufacturing capabilities for wire harnesses and control panels, we will shift to a local production business model, enabling us to develop relationships with leading local companies. While our traditional trading company functions alone made it difficult to develop relationships with local European companies, acquiring manufacturing capabilities positions us as a key opener for customer development. We can then sell products sourced from our suppliers. HTK Europe's strengths lie in manufacturing and quality systems compliant with European safety standards and its capability to custom-produce harnesses and control panels according to customer equipment specifications. The effect of this M&A is to strengthen profitability through local production systems. We aim to achieve high profitability by capturing manufacturing value added within Europe, shortening lead times, and establishing a stable supply system by strengthening procurement and supply within Europe. This will lead to medium-term business expansion and profit growth in the European market.
I am Hiroyuki Tanaka, Chairman and Representative Director. Moving forward, I will explain our measures to integrate cost of capital and share price considerations into corporate management. We believe there are three main challenges to raising our share price. First, our business model is perceived as difficult for investors to comprehend. Second, our results exhibit significant volatility. Third, we appear to command modest expectations from investors. We believe that addressing these three priorities will improve our attractiveness to investors. To achieve a PBR more than 1.0 times, we are focusing on three main themes: improving capital efficiency, enhancing current profitability, and raising expectations for our business. Among these, we believe improving current profitability, i.e., sustaining strong performance, is the most critical. I will skip this part since President Matsuo explained it earlier, but over the past few years, we have reinforced our sales capabilities, sharpened our competitive edge, and adopted a more aggressive market execution approach. Now, I will discuss two main topics in detail: improving capital efficiency and raising expectations for our business. First, regarding ROE and the cost of equity. We have calculated our cost of equity and, through meetings with institutional investors, aligned our understanding. We recognize the cost of equity is approximately 8%. As shown by our historical performance, ROE tends to be volatile due to the nature of our business, but the historical average ROE has consistently exceeded the cost of equity. Because our company handles logistics and distribution within the manufacturing sector and prioritizes customer needs, performance fluctuates due to factors like advance orders and inventory holding requests from customers. Taking these factors into account, our medium-term plan targets an average ROE exceeding 10%, and we remain committed to further enhancing capital profitability. This slide provides more detail on our key initiatives. First, we strengthened IR and SR meetings with institutional investors. The number of meetings with institutional investors increased compared to last year. Top management participated in over 60% of meetings. By engaging directly, top management ensures that issues and suggestions raised in these meetings are actively discussed at the executive level. Second, we modified the standard ROIC formula to better suit our company. While our previous performance evaluation focused primarily on profit-based metrics, incorporating the Sanwa-style ROIC into our evaluation system aims to foster management that properly focuses on capital efficiency. We are deliberately incorporating this measure into evaluations of each sales department to embed capital efficiency focus across the workforce. Additionally, we are enhancing our investor relations to expand awareness of our company. In the current fiscal year, we are prioritizing online information dissemination, including advertisements on widely used equity information websites and the publication of accessible articles summarizing our business model and strategy, with the aim of strengthening recognition of Sanwa TECHNOS among a broad investor base. We also broadcast commercials on Nikkei Morning Plus FT, Monday through Friday 7:05 to 8 a.m., BSTV Tokyo Channel 7. Through these activities, we aim to first raise awareness of our company and then build a pathway whereby investors who resonate with our strategy and vision go on to buy our shares. Finally, we expanded our shareholder benefit program. Details will be provided on a later slide, but this marks the second enhancement this fiscal year. The changes are intended to make it easier for new investors to hold our shares and to improve convenience and value for existing shareholders. As a result of these initiatives, our share price has outperformed the Nikkei average since April 2025. Finally, I will explain shareholder returns policy. As discussed in the section on our measures to integrate cost of capital and share price considerations into corporate management, our group considers it crucial to enhance equity liquidity and expand market capitalization to become an investment target for institutional investors, aiming for a PBR above 1.0 times. Within this framework, we have been committed to maintaining an annual dividend with a target DOE of at least 4% since FY 2024. This fiscal year, we plan to pay a dividend per share of 120 yen, the same as last year. This is expected to result in a DOE of 4.31%. We will also consider share buybacks from multiple perspectives, such as improving stock liquidity, and execute them proactively as appropriate. We have implemented various shareholder return measures to date. Major policy shifts include changing to a dividend payout ratio in January 2023 and switching the dividend-related metric from dividend payout ratio to DOE in October 2024. We introduced our shareholder benefit program in May 2024 and expanded it twice in 2025. The rollout of the new NISA system starting in 2024 broadened the investor base, particularly among individual investors, increasing interest in long-term asset formation. To encourage new investors to hold our shares and utilize new NISA, we implemented the second expansion. I will explain the details of our shareholder benefit program on the next slide. As a result of these efforts, the number of shareholders grew to over 20,000 as of September 2025, approximately 5 times the number in March 2024 before the shareholder benefit program was introduced. Going forward, we continue to provide shareholder returns from a medium to long-term perspective, balancing proactive business expansion for sustainable growth and enhanced corporate value with maintaining financial soundness to navigate future risks. Finally, I will explain the shareholder benefit program. We announced an expansion in May of this year and an additional expansion effective October 31st. There are 3 major changes. First, we phased out the program that offered an additional 1,000 yen or 2,000 yen to shareholders with holdings of over 2 years. Second, we revised the shareholders' categories. Previously, there were only 2 categories: 100 shares or more but less than 200 shares, and 200 shares or more. We established 4 categories: 100 199 shares, 200 to 399 shares, 400 to 799 shares, and 800 shares or more. In addition, previously, shareholders holding 200 shares or more received 3,000 yen for holdings of less than 2 years and 5,000 yen for holdings of 2 years or more. With the latest expansion, shareholders holding 200 to 399 shares will now receive 5,000 yen regardless of holding period. Benefits for shareholders holding 400 or more shares and 800 or more shares have been increased to 10,000 yen and 20,000 yen, respectively. Finally, the third point is a change in the shareholder benefit items. Previously, we had mailed quo cards, but we shifted to digital gifts to enhance convenience. Through these changes, we aim to increase the appeal of investing in our stock, improve liquidity, and further expand our investor base. This concludes our presentation. Thank you for your attention.